Welcome to today's Explainer. We are diving straight in today because we're going to completely shatter the illusion that offshore trusts offer absolute financial secrecy. For the longest time, the offshore trust was basically treated as an impenetrable vault, a magical place where high net worth individuals could stash their assets entirely out of sight. But the world has fundamentally changed, and today we're looking at the hard data and the actual legal frameworks that prove that vault, well, its doors are wide open.
13 trillion euros. Let that staggering number sink in for a second. That represents the total value of financial account information that was automatically exchanged globally under the Common Reporting Standard, or CRS, in the year 2024 alone. We're not talking about a handful of targeted, high-profile investigations or some isolated data leak. No, this is an unprecedented, automated, global tsunami of financial data sweeping right across borders.
And that 13 trillion isn't just sitting in one giant pot either. It is spread out across more than 171 million individual financial accounts that have now been exposed to tax authorities worldwide. Every single one of those accounts comes attached to specific identities, to account balances, and to income details. It's essentially a massive, highly coordinated legal X-ray of the world's wealth.
So hearing those numbers, you really have to ask yourself directly, if your wealth is sitting in an offshore trust right now, are you actually safe from this global data exchange? For years, wealth managers have sold these structures on the absolute promise of invisibility. But as we're about to see from the actual legal mechanics happening behind the scenes, that invisibility is completely a thing of the past. Section 1. How CRS pierces trusts. The end of invisibility.
Okay, so under CRS, a trust is generally going to fall into one of two buckets. It's either a reporting financial institution, an RFI, or it's a passive non-financial entity, an NFE. Now, if a trust is managed by a licensed professional trustee company and its income comes mostly from financial assets, it's an RFI. In that case, the trust itself is legally obligated to report its data. If it doesn't meet those criteria, it defaults to a passive NFE. But here is the critical catch you need to understand. Being a passive NFE does not mean you avoid reporting. Not at all. It just means the bank holding the trust's assets is the one legally required to look right through the trust and report you. So the only difference here is who actually tells on you, the trust itself or the bank. The bottom line is you still get reported.
And the crucial point here is exactly how CRS defines the people it's looking for. CRS borrows this incredibly broad beneficial owner concept directly from anti-money laundering laws, calling them controlling persons. This casts an absolutely massive net. We're talking the settlor, the trustees, the protectors, the beneficiaries, they all get caught. The rules are literally so strict that even a beneficiary in a discretionary trust who has never even received a single penny in payouts is still visible and reportable to the tax authorities. Nobody gets left out of the file.
Section 2. The Bermuda Secrecy Myth, Unpacking the Rumors. Now, let's talk about a rumor that just will not die. There is this widespread, almost universally accepted belief among certain advisors that Bermuda simply refuses to hand over your financial data to the Chinese tax authorities. It gets pitched as the ultimate trump card for asset protection. But is there actually any truth to that? Well, we checked the receipts. And the definitive legal answer is absolutely not. The Bermuda Ministry of Finance's own gazette, which was published in February 2025, explicitly names China as a reportable jurisdiction. Furthermore, public lists confirm that Bermuda hasn't just started doing this. They've been actively exchanging data with China since the 2017 reporting year. So the whole idea that Bermuda is some sort of magical black hole for your financial data is entirely false.
So how did this incredibly dangerous myth even get started? Well, it stems from three fundamental legal misunderstandings. First off, people confuse basic client confidentiality with a legal immunity shield. They are definitely not the same thing. Under the law, CRS reporting is a statutory obligation, and that will always override standard contract confidentiality. Second, folks point to a human rights exemption in Bermuda's CRS guidelines, but they completely miss the fact that this applies strictly to charities where revealing a beneficiary might literally put them in physical danger. It does not apply to your standard commercial trust. And third, there is a massive misinterpretation of Section 30A of the Bermuda Trustee Act.
Let's zoom in on that third point for a second, because it's a big one. Section 30A lets you appoint a managing trustee, which basically takes investment power away from the licensed professional trustee. The whole goal of doing this is to change the trust's classification from an RFI down to a passive NFE.
But as we established just a minute ago, becoming a passive NFE is not a magic shield. The bank or the custodian that holds the assets is still legally required to pierce right through that trust architecture, identify the controlling persons, which, yes, includes you, and report that data directly to China. The data flow does not stop.
Section 3. China's Tax Reality. Offshore Enforcement.
Now, you might be thinking, well, China doesn't even have a specific trust tax law right now. And that's true. But honestly, they don't need one to come after your assets. They just utilize their existing tax frameworks to assess your liability across what's basically a 3-stage trust lifecycle. The risks start right at stage 1, setup. The very second you transfer offshore equity or assets into the trust, authorities can potentially view that as a taxable asset transfer. Then you have stage 2, the existence of the trust, where anti-avoidance rules kick in. And finally, stage 3 is distribution. Now, while those taxation rules at stage 3 remain a bit legally ambiguous, remember that ambiguous doesn't mean exempt. It just means it's highly risky, especially if any payouts are made directly back to the settler.
But the real danger zone, that is undoubtedly stage 2, specifically within Article 8 of the Individual Income Tax Law. If you, as the settler, retain too much control over the underlying offshore companies inside the trust, say by controlling the board or making the final investment decisions, the authorities can bring down the hammer. They'll use Controlled Foreign Corporation, or CFC rules, along with general anti-avoidance rules. This gives them the power to legally ignore the trust entirely, pierce the veil, and tax you directly on the undistributed profits of those offshore companies. So in the eyes of the tax authority, your desire for control literally becomes your greatest liability.
Section 4. The 2025 Enforcement Era. The wave is here. Listen, we are way past theoretical warnings at this point. Right now, actual taxpayers across multiple provinces are getting hit with massive penalties. We're seeing cases like a taxpayer in Shanghai facing nearly 185,000 RMB, all the way up to someone in Xiamen getting hit with nearly 7 million RMB in unpaid taxes and penalties. And what is absolutely vital to understand here is that these enforcement actions are based almost entirely on those automated offshore data exchanges we talked about at the very beginning. The authorities are actively using that CRS data to trigger real-world audits.
And the tax authority isn't just randomly coming after people, they are systematically escalating their approach using a very specific 5-step method. They start off pretty gently with a polite prompt and a reminder based on the data they've received. But if you ignore that, the escalation is rapid. By the time you find yourself at step 4, it's basically too late. A formal file and investigation is opened, which inevitably drags you right into step 5, devastating public exposure and massive, massive financial penalties.
Section 5. The Viable Strategy, Voluntary Compliance.
The era of the offshore hiding spot, it's gone. Completely over. Period. If your strategy relies on finding some dark, unnoticed corner in the global financial system, you are going to get caught. The only viable strategy moving forward is to completely stop looking for loopholes. You need to proactively review your past offshore income declarations right away. You have to assess exactly what your CRS data footprint looks like, meaning you need to know exactly what the authorities already know about you. And most importantly, you have to ensure voluntary compliance and rectify any issues before the tax authorities decide to push you into step 4 of their enforcement process.
I'm going to leave you with this one vital question to ask yourself regarding your own assets or maybe the assets of your clients. Is your offshore wealth structure genuinely built on a solid, compliant legal foundation that can withstand a global data X-ray? Or is it resting on a fading illusion of secrecy that just doesn't exist anymore? Thank you so much for joining me for this explainer. Take a long, hard look at your structures, get compliant, and I'll catch you next time.